Okay, welcome back. Let's go through a quick little update. I want to go over how things have been going on this recent sell-off and VIX spike because, again, I think it's good to see actual real-life things, and everybody likes to talk about their win rate and profit, and I do as well. But I want people to understand, how things play out when they don't go as desired. So if you appreciate that, definitely subscribe and, give me a like for the transparency there. If you don't know who I am, I'm Ben Collins, CFA charter holder, Chief Investment Officer of Options Autopilot, which is an automated options trading platform. If you want more info on that and you want to do a $45 trial for a month, check out the description below. But yeah, let's dive into it. On the eve of NVDA earnings, so I have a couple updates on different positions and just my general strategy. Maybe you've seen that I'm trying to pay my rent. So far hasn't necessarily gone according to plan. So, but I wanted to kind of go over why I'm not concerned and why this should work out over time in general with automation. And then I'm also going to go over the manual position. So try and make it fast. I typically say that, but then I go too in depth here, but I truly will try and make it quick. If you recall, I believe last time I was speaking, I was actually probably exactly up almost this opposite amount. So I was probably up almost $800, I believe, at the time last week. Now that is completely reversed, down $853, just open at the moment. This is incorrect. This is only for this contract. So just for anyone who's not familiar with futures and options on futures, which is what we can do through TastyTrade and Options Autopilot. That is why that's showing as a profit, and this is showing as profit. This is showing a loss right now. If we kind of look at what is happening over the past week, I guess things were kind of looking more positive. It was starting to rebound here. Now it's kind of just come back off, right? So I think the last time we talked about things breaking down, it was on this big bar, and then we basically, that was a fake out, fully recovered. And now we're kind of doing it again. Again, it kind of looks like a double top if we want to look at some technical analysis, because also, ideally, this would have served as support, this previous high. Now that is not the case. Increasing volume. I mean, if you've been following me at all, it's not necessarily unexpected. Valuations are pretty high. A lot of people have made a decent amount of money, so there's no real reason to probably carry risk into the end of the year. So my guess is it's probably a combination of valuations, profit taking, and just kind of a little bit of a change in sentiment in general. You can kind of see now after hours, the futures are up a little bit, but I do kind of want to go over the current position. You can see this is just after hours being up like $60, but I've just been letting the automation run and put on positions. You can see how many I have on of the 111. Obviously these are scaled up because, as I mentioned, I'm trying to basically do $3,000 a month on $40,000. What I do want to mention is I basically got close to my margin in terms of my limit and needing to close down some positions. The reason is obviously I have manual positions on. If I didn't have these open, which is probably taking up another $10,000 to $12,000, I would be totally fine. But you need to keep that in mind because I also had about $7,000 to $8,000 of margin previously. Let's say I put on another position, so I had about $6,000. So I did put on a couple more positions and the market goes against you. You can kind of see, I think it'll show me my cap requirement now. Yeah. So I think it went from, again, I probably put on 2 more positions since then, which is approximately like a $1,200 per, but you get the point. It probably went from 17,000 up to almost 25,000 in requirement. Again, that's because things are technically going against me. Volatility is increasing. That's where I try and highlight, the risk management. You want to use significantly less capital. That's why I don't recommend doing what I'm doing. Obviously, don't do anything that I'm doing as a disclaimer. But this is why it is hard to use leverage and be like, oh yeah, I'm just going to make 3,000 on 40, because you have a lot less cushion if the market goes against you in general. So I wanted to highlight that. I think the tough thing here, what's very annoying, is you can see your gain right now is 29,000. This is skewed because it should be actually higher still. So like I think last update was about 36,000 that I was up for the year. This is getting skewed. I think I'm still up like 32 to 33,000 because of the bid-ask spread is always widening out. Even though this has kind of gone against me in the past week, I should still be flat to up on this position. But you can see, after hours, these things widen out, and then it shows a pretty big loss. So you can kind of see how that can go against you. Same thing with Intel as well. So, these are technically going against me. Rivian surprisingly up a penny today. The market was down quite a bit and then rallied back, then sold back up. Hard to know how to interpret that. If it would have gone positive and stayed positive, that would have been very positive for the market. Quick update on Rivian. I would say kind of skill, kind of luck. I did end up closing my previous position and kind of wanted to de-risk it and then I guess adjust it. So I was up about 3,000 at the time. I closed that down and I had put on only 5 contracts of a 30 strike. I was previously at the 15 strike, so I was in the money. That was, again, both luck and a little bit of risk management, because being that far in the money, I was kind of acting more like stock. So I wanted to get a little more convex, a little bit less risk in case this did pull back more. And it happened to have pulled back more. Doesn't always work out that way. Once it got down here, I did add another 5 contracts. So I'm long 10 contracts. And if this rallies up and breaks above here again, I will add. But as of right now, I'm probably not going to add more to that position. But right now, I'm only long about $3,500 of call premium. So effectively, I'm only taking my profit that I'm up and then risking that now. And again, don't pay attention to the actual tickers or stocks. Kind of just pay attention to the risk management and how I'm approaching the scaling and the progressiveness of my positions if you want to learn something. Again, as a disclaimer, this is not all my capital, and don't do anything that I'm doing, but I just kind of want to go over how I've done this over the years. You can kind of see still up decently. Again, this should probably be flat, so I shouldn't have really lost or really gave much up on current bigger winners. And obviously now kind of hopefully add to Rivian if it continues. XRP still done nothing. So I guess I'll go over this a little bit frustrating. Yesterday when we had the sell-off, I had, as you may recall, I had 2 other kind of hedges that were left on these put spreads from some of my 111. So the automation can automatically close down one of the puts and then leave the hedge on. And they were actually profitable, but not crazy, but they only have 4 days left to expiration. I was like, well, if the market keeps going, those will actually have a lot of gamma in my favor and they'll gain value very quickly. And actually they would have gone in the money, similar to these. The other one strike was like 6,800. So it'd be like significantly in the money. That's one of the benefits of that 111 strategy and just having those hedges on. The issue is I kind of had to manage them. I didn't want to have it reverse because then they would collapse to probably 0 very quickly. So it's like you kind of have to make that call on the hedges. On the other automated one-on-ones, I don't have to touch them. Obviously, when it goes to the hedge, I could just let it go to expiration. I didn't want to go from being up 100% to 0 to having no profit on it, because then it just kind of helps me in the long run. Same thing with this one. I left this on because you can see I'm actually up quite a bit. I'm up 60%. And I've got a long way to go, but then I have some decent time to expiration. And I feel like if it continues to pull back, I think I could end up in the bear trap and again have maybe $350 profit on an original credit of probably $60. So This is the time frame when those one-on-ones can really pay off. You can actually still make money on the downside. Doesn't always happen. I've obviously gotten stopped out. Speaking of getting stopped out, I basically have gotten stopped out of all my Bitcoin put spreads, put credit spreads. So obviously we've seen what's been happening with Bitcoin, and I've been talking about it topping and that breaking down here. So who knows? Maybe we're coming close to some kind of bottom, but in general, I mean, it's been enough to take me out. I still have my automation on. I don't know. Let's see here. We'll go over NVIDIA in a second, and I guess bonds. So yeah, see all these were getting stopped out for losses. So now I'm technically down on the year on the Bitcoin put credit spreads. In general, I'm not bothered by it. It's been pretty choppy. Obviously, I kind of started it around this time frame, and it's just kind of been doing this. Instead of unfortunately, we were trying to catch it when it was kind of going up like this. But either way, long term, I think the trend should be higher. I kind of mentioned, and I need to do a little more research on this. I kind of mentioned, strategy and Michael Saylor having to maybe get forced to sell at some point. I kind of forgot about this, and Josh Brown from CNBC had mentioned it, and I remember thinking, yeah, that's totally ridiculous. It trades at like a very high premium to NAV, which is net asset value. And I think he was saying, again, I'll do some more research on the next one, so subscribe for that update. I think he was saying that it basically, what that means is like it's trading for double the actual value of Bitcoin, right? So if it's holding, let's say, $100 in Bitcoin, again, this is a basic example, it's actually trading for $200. And he was saying, why would it be worth that kind of premium? Yes, you're getting some leverage embedded in there, but like, why would you pay double if you can just, I guess, I don't know, buy it outright to a certain degree? I mean, as I say that, I think maybe it's triple leverage, so maybe you're technically still getting a discount. But either way, I think that means that it could definitely correct a little bit more, just from that kind of technical inefficiency. But we'll see. Like I said, I think that if this continues to pull back and you kind of get an exaggerated move, which some people might say this is exaggerated, it could be a good opportunity to kind of accumulate Bitcoin. I think long term the trend is still there. The tailwind is still there. Again, I'm not a crypto bull or anything. A lot of the big institutions have seen fit that they want to make some money off of it. So, and the administration seems to also want to make money off it. So, we don't trade the market we want. We trade the one that we have. So we might as well use that to our advantage. SOFI is just doing whatever. I kind of want to uncover my call spread at some point if I can get some more capital available, because it is pulling kind of into support of the support level I had previously drawn. So that could be a good time. Intel, I don't know, I'm less favorable on Intel. I think it could pull back down to this level. If it does, then I'll probably uncover my call spread and just be long calls again, hopefully for the next run up in the prices. But that's just kind of nuanced on the side. So NVIDIA is the big name. Obviously, everyone's wondering what's going to happen with it. I mean, I personally think the valuations are crazy. Doesn't mean it can't stay crazy, or that maybe they can still meet expectations. The thing that I would say about NVIDIA that is in its favor is, if anyone, not that I was around during the gold rush, but they always say that the people who actually made the money during the gold rush are the people who made the picks and the shovels, not the people searching for gold. I think it's kind of similar to NVIDIA in that they're kind of providing the tools to use AI. They're not necessarily AI themselves. They're obviously providing the picks and the tools to do the computing power, basically. So they're going to be in demand. In my opinion, though, I'm actually surprised that it still is holding this kind of premium. Is like the whole DeepSeek thing. As soon as that came out, I was actually surprised that NVIDIA did not just it did sell off, but it fully recovered. So I have to imagine there's going to be some type of cheaper alternative. Maybe it's not as good, but maybe you get 80% of the benefit of an NVIDIA chip. I don't know. I could be totally ignorant on that whole front. That's possible. I think I'm actually holding a put spread right now over earnings. Again, it's not a large position. It's just 3 contracts. You can see I put it on earlier today. I'm already up $200. So I put on 2 at first, and then I got up about $90. Wait, I think I put it on yesterday. Put the 2 on yesterday. I was up $90 today, so I added a third. Again, once I'm getting up profit, I'm adding to that position because I'm assuming and hoping that it's going to keep going. Again, it's not a huge dollar amount position. And my thought process here is it's sort of a hedge against the rest of my portfolio, because I think if NVIDIA comes out and disappoints and it sells off, because again, my strikes are the 170, 160, so not too far away. They're very short expiration. They're going to expire in 11 days. I think it's totally possible that you could get a move down to 160 pretty easily, probably 150 on a bad number, and if people want to just take profits. So if that happens, I theoretically, should make about $2,700. If that does happen and the whole market is selling off, obviously I might be down a grand or two on my 111. So I'm kind of doing it as a protective hedge. Again, it could be the total opposite, right? It could be that NVIDIA beats and goes up and the market itself falls, and then I'm kind of screwed both ways. That's called basis risk. So I'm taking that kind of risk, but I think the risk reward is decent here. And if it actually comes out positive and the market does rally, then again, this should gain a lot more in value than my NVIDIA puts, expiring worthless, basically, which would be about a $300 loss. Could easily make $300 in a day if this is going up. You can already see it's up $106, and the market is only up 0.15%. That's just the nature of having to be on the S&P 500 index versus just an individual stock with a equity option. So that's kind of my thought right there. That's what I'm doing. Again, I don't want the market to totally fall apart. I would love if NVIDIA just had a small drop, and maybe we just had a small drop in general. Again, one of the reasons I'm not concerned about the automations. Let's just look at this actually really quickly. Because we can kind of see, so the stuff that's closed obviously has been profitable. This stuff that's open is currently not. Stuff that has basically been opened recently is down a little bit, but it's just the fact that I've got multiple positions that are down a little bit, and I've had to adjust some of my allocation. That's why you see some failed here. But had a couple profits, but then it just keeps putting them on, and you're down a little bit, and obviously that adds up. But the whole thought process is, you can see here, I went from 1 to going up to 3 when I decided I wanted to try and make the $3,000 on 40. That comes with extra risk, right? My stop loss is all the way at $649, but my profit is now $233, right? So basically tripled everything, approximately, not quite. So that's kind of the hazard, but also the potential benefit here. And this is what's happening across the board. It's not like I'm down a ton on any one position. It's just that all the ones that I have across the board are down slightly or a little bit. So that's good and bad. Again, the way I tried to describe it and why this should work out over time is volatility is mean reverting. So no matter what the market does, volatility will go back to its average level. Even if the market falls, 60% and it spikes like this, actually even higher, it will come back. It's just mathematically how it works. So you can see that VIX is spiking up here a bit. And again, the benefit of doing the automation, it's putting it on regardless. I'm not having any input, right? So it's kind of doing it down here when VIX is low. It's also doing it as it's getting higher and also when it is high. And again, I think that's benefit because my average kind of volatility level that I'm selling at then kind of averages out over time, and I should be getting more premium as the volatility is higher if I just can consistently do it. But right, the risk management is the name of the game. I need to be able to survive like stuff like this. I am pretty short Vega, so if something like this happened, I would probably suffer some decent losses pretty quickly. And again, that's what you kind of have to be aware of. and the sequence of return risk is real. This is why I say, if you do this, you kind of have to assume maybe you might have a drawdown initially, and that's why I'm kind of doing MES versus ES. Because imagine if I started out with just doing ES, which is 10 times larger contract, I would be down significantly more money even just doing that. So this has been good to kind of leg into this. You can kind of see, I've levered it up on some of these days to expiration. Some are still 1, some are 2, some are 3s. I'm just trying to get a little diversification there across the board. Again, if this could expand a little bit more, I'm up, 178%. So again, this should highlight a little bit of leaving the hedge on, but also the 111. It could end up finishing like this in general. So if it keeps going down, I have this other hedge in place. Again, this is small dollar amounts compared to how many other ones I have on now, but every little bit helps. It's a marathon, not a sprint. All the other sayings I can come up with in this video, I'll try and think of them, but that's it. That's what I'm doing. We'll see what happens with NVIDIA. I think a lot of people are kind of bracing for a move to the downside, so that could be that it doesn't happen. I will be curious. I don't know statistically how significant this is, but I feel like if NVIDIA is down during the day, it's possibly going to be up after hours, and then vice versa. Usually if it's like up going into earnings, it can also be down after hours. But again, I've never quantified that, just anecdotal observation. So we'll see what happens. I think the market could have a relief rally if the earnings are still intact, because obviously it's I think the largest company at this point in terms of market cap. So that could impact the S&P in general. So if I can be profitable on this put spread on earnings, that'll just kind of probably help absorb some of the losses on the other positions, and that's kind of what I'm trying to do, right? I'm kind of dampen my downside, and then as we kind of flatten out and kind of go up, again, I should be benefiting. I'm making $146 a day theoretically from Theta, but I am short quite a bit of Vega here, and that is how that works. So we'll see what happens. Stay tuned. I will update, subscribe if you want the update, and all the transparency on everything. I'm going to still add some other positions. If we keep getting some pullbacks, I might do some adjustments. The one thing I was going to mention last was I took off some of the bond positions again, and I got stopped out of, no, I think I got a profit take on oil. Yeah, I think I got a profit take on oil. And then I closed down my bond positions only because I wanted to leave myself a bit more margin for if the market kept falling. So that's the only kind of management I would do. And again, I wouldn't have to do this if I was not trying to do it in such a levered way. So that's another lesson. Don't do it. Trading with too little capital is actually very detrimental because you end up taking too much risk. And that's how you can kind of blow yourself out. So use proper risk management. Don't swing for the fences. Survive to trade another day is what it's all about. And automation, just taking yourself out of it and just letting it go. Because like I tell people, even if I were to pass away, if this account was just still running that 111 all the time, I am extremely confident it will make quite a bit of money in its lifetime, even if I'm not around. So that is the power of the benefits. So keep your risk managed, and we'll see you in the next one.